Well, terrific. Thanks, everyone, for joining the Vox Royalty Corp presentation. A quick thanks to the Noble team for throwing an in-person conference. Certainly nice to be back in person with everyone. We're in an interesting time, obviously, right now with record inflation, geopolitics, certainly causing risk within the capital markets and in really all kind of investable assets at this stage. But this inflationary time is not something any of us have seen for at least a generation, and it's certainly increasing the interest in commodities. But how to get the right exposure in commodities is really at the forefront of a lot of investors' minds, and we'll get into this, but I believe Vox Royalty Corp is one of the best places to be investing in commodities and get the right kind of exposure during these inflationary times with exposure to the right kind of metals and the right kind of opportunities. So, over the last 25 plus years, royalty companies have outperformed essentially every commodity-based benchmark that you can compare them to. That's the physical metals, that's the ETFs, that's the mining companies, that's even the S&P 500. Royalty companies are kind of that little known secret in the commodity world of how to get a very, very compelling form of exposure that leaves you with essentially leverage to the precious metals and leverage to the metal prices without a lot of the risks that afflict mining companies. So royalty companies give you a direct revenue interest in mining projects globally. So think about a producing gold mine. They do $100 million in revenue. What our company does is we go buy essentially a 1% revenue interest in those projects, and we buy them from third parties. So that's usually the prospector or the group that originally found this geological anomaly. They then sell the project usually for cash and a royalty. The royalty represents their perpetuity interest in this project and the future revenue generating capability of that project. That royalty is what we buy. So we're not funding mining companies. We're finding people or groups or entities, parties that own these royalties. And I'll give you a very quick example of a royalty that we purchased. There was a family of ranchers in Nevada. The land had historically obviously been used for ranching. It became prospective for gold. A gold mining company ended up coming in and buying the mining rights to that asset. The family of ranchers kept a royalty. They sold the mining rights for cash. We bought that royalty about a year ago from this family over a project. It's a multi-million ounce gold project. It is progressing towards being in production over the next 18 to 24 months and is a very, very productive royalty for us. But we bought that royalty from the ranchers. We have nothing to do with the mining operations. We're not the company that's putting enormous amounts of capital into mining operations, nor are we exposed to many of the risks that mining companies face. So when you buy a royalty, what are you getting? You're getting leverage to the upside in commodity prices. You have fixed operating costs, a very capital-light business. We have all the exploration side. So when a mining company goes and drills more and spends money on development, we get all of that upside without having to pay for it. We also have tremendous diversification. So a company like Vox has 55 royalties and streams all around the world, predominantly in Tier 1 mining jurisdictions, Australia, Canada, and the US. We get the benefit of diversification still with the torque of a small cap company, and an extremely scalable business. So we've been the fastest growing company in the royalty industry over the last 3 years, and we've added a significant amount of value, really exceeding what anyone else has done on a per share basis over that corresponding period of time. So going back, royalty companies, because of that asymmetric opportunity and less risk, have historically outperformed everything else that would be considered a benchmark to a royalty company in the commodity sector. So let me give you an example of why royalty companies are so profoundly positive versus, say, if you're a generalist investor looking at mining companies. The reality is, because royalty companies are not exposed, we're not contributing capital. So when we go buy that third-party royalty, we're not funding the mining company and all the capital that needs to go in to progress that project. We're the benefactor of that, but we're not exposed to contributing that capital or enduring any of that risk. So this is an example of the biggest company in our space is called Franco Nevada. They're a $30 billion royalty company. They've been around for approaching 30 years. In 2011, they make this investment into a company that's public that has essentially this single asset. What it shows is the mine is actually produced very, very well. It highlights one of the risks in owning mining companies versus owning royalty companies is that the royalty interest is really essentially never diluted. It's that perpetuity interest in the revenue generated by a mining project, and that's a very powerful form of investment because we're not exposed to the dilution that eats away a lot of the future cash flow generation on a per share basis to mining companies. So this is a prime example of why owning a royalty company is in many ways a better investment or a better investment opportunity. So this investment gets made. the royalty company has actually already been paid back, and they still have another 6 years and probably more than that in reserve life, so they're going to realize a multiple on their investment. Meanwhile, investors, while they invested in a project that probably touted that they had a good asset, and in many respects it probably was, have actually lost about 50% of what they invested. Same project, the royalty owners have won, the equity investors have lost. This is the problem in owning mining companies quite often, is that the dilution, even if you pick a good project, which can be very, very difficult to do, your dilution eats away at the value that you thought you were getting, and ultimately you end up with not the return you hoped for. That's why Vox was created. We were created to solve this problem for investors, for the generalist investor that says, I want commodity exposure. How do I get commodity exposure? What is that? What's the right vehicle for the exposure that I'm looking for? We have unprecedented inflation. I think if you look at it from a stat I heard the other day was, if you actually apply the 1980s metrics to today's inflation numbers, they're much closer to 20% than they are 8%. So it's unprecedented in many respects. Commodities have outperformed during these cycles time and time again. I think, in fact, out of the last 9 inflationary regimes, commodities have outperformed. Well, then within the commodity sector, what are you looking for, and what has been the best form of investment? That's royalty companies, and we built this business about 10 years ago to be that answer for investors in this type of market environment. So what separates us? There's other publicly traded mining royalty companies that exist. What separates Vox Royalty Corp? We have a unique proprietary advantage. In 2018, we started working with a database that had over 7,000 of these third-party royalties on a proprietary basis. It was built from first principles and primary data all over the world, accumulating the information, leading us to where these royalties were essentially hidden and most of our competition was blind to. Since that point in time, we've been the fastest growing company in the industry, but its growth at unbelievable value is what this enables us to do, systematically and repeatedly find value that others can't in the space. We have a team of technical experts on the front lines of our business. Mining has some very significant esoteric risks. If you're not a mining engineer, if you're not a geologist, if you haven't been investing in the space for 30 years, there's a lot of very, very specific risks that exist in these projects and that go into picking the right projects that make it very difficult if you're not one of those technical experts to do on a successful basis repeatedly and consistently. So it's mining engineers and geologists at the front lines of our business doing that for you. And what we've been able to do is drive the highest return on invested capital in the entire sector. It's not something that you will hear very much mining companies or companies in the commodity sector talk about, but our return on invested capital, our ability to find royalties at fundamentally fantastic value and have that translate to growth in terms of real value of the business is really unprecedented in the space over the last decade. So what have we been able to accomplish? From 2019 to now, we've been the fastest growing company in the industry. We have 5 producing assets now. We expect that to be 10 by 2023. Ultimately, what our interests are revenue interests in these projects. We're taking a % of the revenue. What does that mean? We're not exposed to all the cost inflation and all the cost infrastructure of mining companies. So with inflation going up, mining companies' costs have also gone up. We're not exposed to that. So these producing assets get the benefit of a rising commodity market without the drag of higher prices and higher input costs eating away at your earnings power. So we've been able to grow our producing asset count, meaning revenue's growing up, but our costs are not going up proportionally. We have very low geopolitical risk. We're the second largest holder of hard rock mining royalties in Australia. Western Australia, which is where most of our royalties are, has just been ranked the top mining jurisdiction on the planet. And we have the leading growth rate in the entire industry, both from a NAV per share perspective, from a revenue perspective, and from a new royalties brought into the portfolio basis. I'll give you an example of a transaction that we closed. We were able to buy a royalty over a project that is 50 million gold equivalent ounces under resource. What does that mean? It's a generational ore body that can produce $3+ million a year of revenue when it comes back online for decades and decades. We bought this royalty for $1.5 million up front. How were we able to do that? We were able to do that because we had information that no one else in the industry had. We were able to find a prospector that held this royalty. This royalty had been held for almost 30 years. The company that actually brought this asset is a previous producing asset. It's operated by Sibanye-Stillwater. They're a $12 billion multi-jurisdictional operator. This royalty had essentially been long forgotten. So the prospector who was looking for estate planning and an ability to diversify some of his interests, when we approached him and said, we'd like to buy this royalty, was very enthused to be speaking with us and have the ability to bring that opportunity forward in terms of a realization event for him and his family. But this royalty, when it's in production, could be worth $150 to $200 million. We're buying that for $1.5 million up front. So quick overview on Vox and our capital structure. Again, we started in 2013. We've been around for almost 10 years. It was focused on creating a company that allowed investors to invest in commodities in the right type of format and a really scientifically proven pathway for success in terms of getting the right type of commodity exposure. So we have about 140 million CAD market cap. We're listed on both the Toronto and the OTCQX. Jumping ahead to closer to the end of the presentation, we have applied for a Nasdaq listing. We're expecting to get that listing in June or July. That's going to be a very significant event for us that will unlock a lot of liquidity and open up the door for many more investors investing in Vox Royalty Corp. We're in a great position. We have about $10 million of working capital. We have the ability to take on debt when we want to scale the business and continue to build the business. We've been able to bring on some of the who's who of fundamental gold investors. Some of the top investors really in the world today have become shareholders of our company. Conwave is also known as Gold 2000. They're a Swiss gold-focused fund that's been around for 2 decades now and one of the sharpest fundamental investors in the space. US Global out of Texas has built a very meaningful position in us and many, many others. So quick highlights on our portfolio. We have, again, the second largest holding of hard rock mining royalties in Australia. Australia is the best mining jurisdiction, specifically Western Australia, where most of our royalties are, again, was ranked the #1 mining jurisdiction. It's great. There's the people there. There's the infrastructure there. There's the rule of law there. There's the appreciation for mining fundamentally in Australia that's also very significant. In Western Australia, you can bring a mine from first discovery to production really faster than anywhere, and that's what's led to a lot of our growth, is our ability to find these royalties at fantastic value in uncompetitive markets and continue to build Vox on a very disciplined basis. So when you get Vox, what are you getting? You're getting a company that has 5 producing assets now. Put that in context, we're about 140 million CAD market cap. To get a company that has that type of diversification, if it was just a mining company, it would typically be a multi-billion-dollar operator. We're going from 5 to 10 to 15 plus assets that will be in production generating us revenue where we're not exposed to the risk, we're not exposed to the cost structures. So it's a very, very torquey business model. The reality is we're able to grow it faster and at better value than pretty much anyone else in the space, and we're continuing to build a company that is gaining traction in the capital markets for our ability to do just that. This, I won't go into great detail on it. It shows the amount of projects that we have pushing to that ultimate catalyzing event, which is when they go in production. Ultimately, we're measured based on the revenue that we're able to generate and the cash flow profile that we bring forward for investors. This is unique. If you were to own a mining company, they would have 1 or 2 or 3 projects. We have over 55 royalties and streams, and we're cherry picking the best projects that are near production, where we find the best value arbitrage for our shareholders. We're finding assets that are right on that precipice of production, royalties that have been forgotten about in uncompetitive situations. We're not sitting there winning bidding wars for these assets. We're able to find assets where we're the only party at the table. We're creating a liquidity event for a group that historically has had none. They have an esoteric asset that needs a home, and we're that home. This is a little snapshot of some of the 55 royalties and streams that we own and some of the expected catalysts that these assets are going to be realizing. If we were the mining company that owned these assets and was responsible for the billions of dollars that's being spent on these projects, each one of these boxes would represent, there'd be another 10 bullet points under that explaining the various catalysts that are happening. This is just a synopsis of some of the catalysts happening within our portfolio. And the really important key to remember, we're not funding any of that growth. We bought the royalty over the last 10 years at very good value for where it was at that point in time. And then we have not had to contribute any capital to the continued growth and value of those assets in the portfolio. And what we're seeing is in this inflationary environment with commodity prices, some at all-time highs, some actually being shut off of the London Metals Exchange because the price has appreciated so fast in the case of nickel, we're seeing a tremendous amount of buoyancy in the mining company's ability to finance and bring these assets forward faster than we expected, and usually with more invested capital, meaning there's more resources in the ground and the production profile is increasing. We're getting the benefit of all of that without having to contribute the capital to it, which is highly value asymmetric in our favor. So why Vox and why now? We have seen a tremendous amount of increased interest in Vox given what's happening with inflation and investors being interested in finding commodities and how to get the right exposure within that marketplace. We believe we're uniquely positioned, really like no other company right now in the industry, to provide tremendous amount of value but also a tremendous amount of growth with the right type of exposures. Our asset growth in terms of producing asset count is increasing faster than anybody else in the industry. We're able to continue systematically and repeatedly find value that others cannot. And we have, from a fundamental perspective, we're increasing liquidity, increasing investor awareness. We've only been public for 2 years. The Nasdaq listing is going to be a huge external event for us in terms of driving value. We trade at a discount to most of our relative comps. A lot of that has to do with us right now only being listed on the Toronto and having an OTCQX listing. The Nasdaq listing has been, on a precedent basis, very, very successful for some of the comps in our space, where liquidity was up more than 750% and share price also followed along. So from a fundamental perspective, we're doing all the right things in terms of driving growth and opportunity and value for our shareholders at an unprecedented level. And then we're doing all the things from a stock perspective or a technical perspective of increasing liquidity and increasing the ability for investors to invest in Vox Royalty Corp. So with that, I think we have a few minutes. If there happen to be any questions, happy to open it up. So kind of a two-part question. First question was, how do we think about making our royalty acquisitions? And then two, from an M&A perspective, how do we look at the world given that the royalty sector is consolidating right now, which for smaller companies like Vox is typically considered a good thing. The reality is we're buying royalties in uncompetitive situations. Most of the royalty industry has been built by buying portfolios of royalties from the major mining companies at absolutely top dollar. What we've done is we've taken a very disaggregated space where there's all these third-party royalties held by, we bought royalties from telecommunication companies, automotive parts manufacturers, hearing aid companies, prospectors in the bush in Western Australia to family offices in South America. We've taken a completely disaggregated asset class, and we are the ones with intellectual property aggregating it. So we're avoiding all those competitive situations. To the best of our knowledge, the 25 royalty transactions that we've completed over the last few years, none of those have been a competitive process. So that really differentiates us versus everybody else in the industry. In terms of what's happening in M&A, look, it's a really interesting time period because the valuations of companies are increasing in the sector. There have been a lot of companies that are larger than us that are new entrants in the space but don't have the intellectual advantages that we do from a database perspective, from a deal sourcing perspective, and our capability to find royalties is really unique in the marketplace. We have one of the most exciting portfolios. We have one of the most, in our opinion, and I think it's very objective at this stage, one of the most undervalued portfolios in the industry. So we're certainly, I believe, for multiple companies out there, an interesting target. That being said, we continue to have our heads down executing the business until it makes sense not to. Oh, sorry. No, that's a great question. So management owns about 15% of the company. And so everything that we do is really with complete alignment with shareholders. So when it comes to the M&A conversation, when it's the right time to sell, then you have a management team that's very aligned and incentivized to make the right decision. So we are about 80% precious metals. That being said, when we find really good assets, really good royalties over really good projects at fantastic value, for example, we bought an iron ore royalty at about 1 times cash flow. It was buried within a telecommunications company. that's a deal that's just really hard to pass up. We have a diamond royalty that we bought at 1.5 times cash flow. Now keep in mind, the industry trades at anywhere from 20 to 40 times cash flow. So when we're able to find those types of opportunities outside of precious metals, we do that, and we're uniquely capable and positioned to find those royalties that others really are blind to in many respects. So we've been able to bring in royalties across the spectrum of hard rock mining commodities. There are some that we won't touch. For example, we don't do coal, we don't do anything that has ESG sensitivity on it. But we have royalties over nickel projects, we have royalties over copper projects, and that's really provided, I think, outsized buoyancy and an opportunity within our portfolio that many royalty companies don't present for their investors. So we have the good question to be asking ourselves with our cash flow growing as much as it's expected to. Do we continue investing that capital at what is the highest rate of return in the industry, or do we start returning that capital to investors? The compounding value of what we're creating, I think it's deleterious right now as a growth company to have a dividend. Do we have that capability? Yes. Most of our direct peers are doing less revenue than us, less growth than us, and so while we're able to continue, while we're at this undervalued state, and we're able to continue to grow faster and better than anybody else really in the industry, we're likely to keep growing the business accretively until we reach a point that it no longer makes sense to not be bringing capital back to shareholders. We have initiated a buyback, so that is a form of capital return to shareholders, but a dividend is certainly on the horizon at some stage. Yeah, we actually have a slide on that. And so we have, and this really demonstrates the value that we're able to create for our shareholders. We've deployed about $35 million into royalties, and our market cap is a little over about $145 million in Canadian dollar terms. Put that in perspective, what a lot of the industry is doing right now is it's taking $1 from investors and buying assets at 1 times NPV and hoping that there's an arbitrage re-rate that happens. Our business model is very unique in that we're buying assets for fundamentally 0.2, 0.3, 0.4 times what that NPV, or what they call in the industry net asset value, is worth, and we're doing that systematically and repeatedly. Yep.
I guess then your stock is so much higher. You use stock as the acquisition versus cash.
Look, we look at our stock as deeply undervalued. So for the last year, I believe other than one transaction, we've funded everything in cash. We've been very stingy with giving out equity and avoiding it when we can do that. So we believe our stock is tremendously undervalued versus the comps. So we've been, with a very good working capital position and generating positive cash flow, we've been able to use cash to acquire royalties. Terrific. Well, if any other questions come to mind, Spencer, our Chief Investment Officer, is also here. Happy to take questions. We'll have another breakout session, I believe, tomorrow. And feel free to tap us on the shoulders. But thank you for your time. Thanks to the Noble team. It's been an absolute pleasure.